Yeah, Jonathan York from Bay Financial Partners, looking at the investment markets. Really quite interesting situation now developing in the US, where after the latest round of employment data, which was again very strong, 280,000 jobs created, and upward revisions to the last couple of months as well. Although the unemployment rate increased a little bit, that was because more people are actually looking for jobs because more jobs have been created. But still a lot of talk in the US that the Fed will look to delay the rate increase going past sort of September, October of this year. Now, the reason why this is quite interesting because the Fed have been pretty adamant all along that if the data supports it and the economy is growing and is robust and is strong, then they will look to increase rates and get them back to a more neutral level. A more normal level. Because clearly rates are artificially too low in the US and do need to get back to a more sort of normal level. But that doesn't mean you're going to see sort of half a point increases at every Fed meeting for the next sort of 6 to 9 months. It will be a slow, gradual increase, with the first increase coming, I believe, between sort of June and September of this year, and will be a 25 basis point increase. The Fed have to be careful because they back themselves into a little bit of corner by saying sort of when the data does show improvement, then they'll look to increase rates. Well, the data is showing improvement, the economy is recovering, is getting stronger, and if they don't look to act on that, it then makes it very difficult to sort of believe what they're sort of saying at their various meetings. Here in New Zealand, obviously all eyes will be on the Reserve Bank on Thursday. Again, a lot of talk about they're looking at sort of cutting interest rates. Well, at the last meeting they said, well, if the economy does weaken, then they would look to cut interest rates. As I said, that's pretty sort of standard, sort of basically 101 economics. But at the moment, that isn't really sort of filtering through into the economy. The economy isn't weakening dramatically. And certainly in the non-tradables as well, there's still quite a bit of inflation out there. You've got medical inflation running at sort of anywhere between sort of 5 to 7%, and certainly with the electricity prices, utility prices, etc., all the money that comes out of people's accounts on sort of a regular basis, they're really not showing any signs of standing still or even deflation. So not expecting a cut this month from the Reserve Bank. It'll just be interesting to see the commentary that accompanies the announcement. Certainly the economy, if it does get weaker, then yes, you would expect to see lower rates. But I say that's not really the case. And also as well, you've still got that booming housing market, especially in Auckland, where the year-on-year increase was around sort of 15 to 17% for the last year. Now certainly if you cut interest rates and make mortgages cheaper, that's just going to exaggerate that move. So it could be quite an interesting time out there. So you certainly watch the Fed. Certainly the US dollar is still reasonably strong out there. New Zealand dollar is weakening a little bit, which is sort of helping the economy as well. Oil has come off its highs as well, and that's sort of trading down a little bit. And that should be a little bit of welcome news to the consumer at the pump. Looking for income, there's plenty of options out there, and if you're interested, call us on 0800 867 323. Or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we look forward to speaking to you soon.